Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, April 17th, 2020. And our top stories today: the coronavirus pandemic is fintech's greatest challenge to date, and banks prepare for bad loans and defaults. Joining me now is Devin Banerjee. He's a senior financial services editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, a newsletter you should check out and is available on the LinkedIn platform. Devin, thanks so much for joining us on the program this morning.
Always good to be with you, Jeff.
Yep, it's great to see you, and we missed you last week because of the Good Friday holiday, but news does not stop, and I feel like, Devin, before we jump into it, that being that we're all working remotely, we're doing a lot more, and the news cycle is now speeding up, if that was possible.
That's right. No, absolutely. There is a ton of news all day, 24/7 now. And I think, as you and I were just talking before we started recording, it's kind of hard to differentiate, what's important, what's not, when to read the news, when not to read the news, when to work, when to relax. But on this program and on my segments, I always try to highlight, the top conversations happening on the LinkedIn platform around finance, around investing. So the first one I'm going to bring you today, Jeff, is about the fintech ecosystem. You and I have talked a lot about fintech over the past few years, and there's really the storyline emerging now during the crisis that this is actually a huge opportunity for fintech to prove itself, to prove its case, and to ingratiate itself into the mainstream. So if you think about what fintech, startups and fintech companies are always trying to do, they're trying to convince people that they're an easier way to access money, right? That they're faster, they're cheaper, there's less friction, and that they may be more trustworthy. If you think about what this crisis has presented us with, unfortunately, the economy and commerce has kind of ground to a halt. Tens of millions of people are out of work. We're seeing those jobless claims every week ratcheting up, or at least continuing at those record levels. Businesses are shut effectively by government mandate. So this is one of those opportunities for fintech to make its case and say as people are trying to access money faster, cheaper, now's the time. So what are we seeing already? Well, there are those two big programs coming from the government. There's the direct relief going to Americans in the form of $1,200 checks, which are now on their way. There's also the Paycheck Protection Program, which is aid for businesses with fewer than 500 employees. And these are loans that actually become forgivable grants if these businesses keep employees on the payroll for at least 8 weeks, right? So we've heard about these programs. So as of just about a week ago, we're filming this on Wednesday, full disclosure. So in the past week, for those $1,200 checks, the IRS has approved PayPal and its service Venmo, and Square and its service Cash App to actually disperse those $1,200 checks directly to Americans who have those services. So fintech has really gotten a foot in the door there. Mm-hmm. For the Paycheck Protection Program, just this last Friday, so a week ago from when this will air, we saw PayPal get approved. So Dan Schulman, the CEO of PayPal, actually revealed this on LinkedIn that they were approved for those Paycheck Protection Program loans, to administer those loans, which are backed by the Small Business Administration. QuickBooks, owned by Intuit, has also gotten approved. Funding Circle just today, again Wednesday, the day we're recording this, got approved. Square Capital got approved earlier this week on Monday. There are other fintechs that are partnering with banks and at least taking applications. So those include Cabbage, Fundera. There's also this whole part of the ecosystem that are kind of back office fintechs, if you will. They're handling the KYC, the AML, or the Know Your Customer process, the anti-money laundering process. Banks are relying on them. Because if you think about it, what's happening is we have to kind of balance speed in this regard and trust in the financial system. Speed is really important right now, Jeff, as you and I have been talking about, because these businesses that are relying on the aid really don't have a lot of runway. In many cases, just a couple of weeks of runway. They need the money as fast as possible. So do those everyday Americans with the income levels where they qualify for the direct check. So I think that's going to be the interesting conversation going forward, and maybe kind of a post-mortem on all this, which is how was the trust element handled by all of these fintechs who have really stepped in very quickly?
Yeah, I mean, I guess from my perspective, Devin, I use Venmo, I use a lot of these different tools.
Yeah.
I don't and we've seen Zoom, not that that is a transactional based application, but we've seen that really take off. I was sold, maybe I'm just naive, but I've been sold on technology being part of this greater financial ecosystem. And I get it. I think that every aspect of our financial system now is strained, government's strained. So if you're thinking, if not you, but I mean, if the general public is thinking that this is just going to be a cakewalk in terms of transiting money back and forth, that's just not going to be the case. And we know that people had site delays, and we know that, these antiquated, for example, like unemployment insurance at the state level, antiquated systems. So, I don't want to just pick on, I think it's nice to see companies step up like General Motors and Ford and others, kind of changing their business platforms and, building respirators or ventilators, And it's nice to see that fintech companies jumping in and helping out. So I see this as a win-win all around. And I'm going to expect bandwidth challenges. Just going to happen.
No, of course. And I think what we're seeing and what you just kind of alluded to is that in this sudden crisis environment that we have found ourselves in, necessity is that mother of both invention for some of those companies you just talked about, GM, Ford, pivoting their manufacturing lines and models and distribution, systems to be able to create necessary equipment for the health care workers. We're also seeing, though, for fintech, necessity has become the mother of almost adoption, if you will. People need that money quickly, and trust has kind of fallen a little bit, which I think, as I said, is the important conversation we're going to have after all of this. But necessity is the mother of adoption here for fintechs, because people need all of those things that fintechs say they offer, which is speed and faster access, cheaper access, just more easy and efficient access to money.
And I wonder, Devin, and I'm not, our segment isn't necessarily about this, but cryptocurrency and blockchain. Does the underlying technology of cryptocurrency, the blockchain, does that find a way? I know that I have read, and again, we're pivoting off of this topic a little bit, but I have read where blockchain and artificial intelligence have been used in terms of coronavirus detection and device, wearables and kind of sequencing. But I wonder if this could also be an area where cryptocurrency, a lot of people aren't completely adopting it, but I'm wondering if this is an area where digital assets can step up too.
Yeah, from my vantage point, that conversation hasn't really evolved so much in this crisis. Of course, I think both sides, if you can simplify it as two different sides, have kind of dug their heels in and made the case for the need to adopt cryptocurrency. Even when this crisis first began and the markets were just gyrating wildly, a lot of people were talking about it as a hedge. But of course, we did not see, assets like Bitcoin really act like a hedge as the markets were falling. But I have seen that conversation evolve, as you said, for people talking about verification, for testing, as we start testing the population, keeping track of who has the antibody or who has had symptoms or who currently has symptoms. Of course, some kind of distributed ledger technology could probably play a role. But as I said, I haven't seen that conversation really advance to the point where, policymakers or anyone in positions of authority are actually picking up on that just yet. But I think that maybe after kind of the immediacy of this crisis fades, I think a lot of these conversations will be had, because this has just accelerated all kinds of technological adoption and potential disruption.
Yeah, and I think to your point earlier and what we talked about, I think a couple of weeks ago, it's about prioritization and survival. And that's why having the apparatus in place to make these payments very expeditiously and directly deposit them in a safe manner is very important. Well, Devin, I want to hold you over because we always do two stories. And when we come back, we're going to talk to Devin about, it's earnings season and bank loans may be an issue. So you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee. He's a senior financial services editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, a newsletter that is free to subscribe to and available through the LinkedIn platform. You just got to look up Devin's name and be his friend. Devin, thanks so much for sticking around with us this morning.
Thanks a lot, Jeff. If there's one thing I need right now, it's more friends, definitely.
What are you up to? About over 100,000, right? I think when we chatted a couple weeks ago, it was over 100,000.
Yeah, This Week in Finance is approaching about 150,000 subscribers. As you said, Jeff, it goes directly to you in a notification on LinkedIn every Friday when we publish it. Also sent to your inbox, and it rounds up the top conversations by the finance community on the LinkedIn platform every week.
Yep, good read, and what great way to aggregate and see what is the most important topics on the platform. So that being said, Devin, earnings week, bank loans seem to be an issue. What can you tell us there?
That's right, Jeff. It is earnings week. And we saw several of the big Wall Street banks report this week. Again, full disclosure, we're reporting this on Wednesday, so I'll bring you a couple numbers we've seen so far. The numbers are not pretty. A lot of it driven by provisions put up by these institutions for bad loans, for potential defaults, for soured loans. So JP Morgan reporting a 69% decline in its first quarter profit. These are year-over-year figures compared with the first quarter of 2019. Wells Fargo down 89%. Bank of America and Citigroup and Goldman Sachs all down about 45%. So again, not pretty. But one thing I want to point out is, there are some banks more exposed than others. A lot of the eyes now are on the big consumer and credit card exposures among these banks' portfolios. So those are banks like Bank of America, Citigroup, JP Morgan, who have more exposure than the others. Also a lot of attention now on that flashy nascent consumer bank that Goldman Sachs rolled out just in the past 2 years called Marcus by Goldman Sachs. That was meant to really disrupt the consumer banking space, really diversify Goldman Sachs' business model. And of course, a lot of that is consumer lending. So we'll see the stresses, if the stresses come through there at their consumer bank and what that may mean for them going forward. I do want to pivot a little bit, though, and talk about some bright spots, or at least some nuances in these earnings reports that a lot of people are picking up on. The first was the trading businesses. The trading floors were extremely active in the first quarter, as that market volatility just skyrocketed. So fixed income trading businesses at Citigroup posted its best quarter in 8 years. At Goldman Sachs, the fixed income traders posted their best quarter in 5 years. JP Morgan's bond traders up 34% in terms of their profit. Another nuance is also in investment banking. So of course, investment banking revenue is down, driven by the real the halt, almost effectively the halt in big ticket M&A, in IPOs. We had a lot of those on the docket for the year that have effectively been pulled or at least suspended for now. And so listening to the earnings calls with management this week, there was a lot of talk about creativity happening among the investment banking profession. So a lot of people saying, look, combined with companies' need to raise cash these days, we can expect more deals like you may have seen in the past 2 weeks, Jeff, Airbnb raising $2 billion across two different deals in debt, both this week and last week. These investment banking executives are saying expect more of those creative fundraisings that give mandates to investment banks and at least some revenue to those investment banking divisions. More deals like that Twitter deal you and I talked about a couple of weeks. They also raised $1 billion in a convertible note. So a lot of these investment banks are looking to kind of pivot or at least make their bankers more creative. You and I talked about a week or two ago about restructuring businesses, restructuring advisory groups really picking up, of course, because unfortunately so many businesses need to address their liquidity positions, their balance sheet issues, and will turn to investment bank advisors for that.
Yeah, and just going back to what we talked about in the first segment, you mentioning the loans and the expectation that there could be defaults. I think this is why it's so important to get money in the hands of these small businesses, because we don't want them to default, because it has this impact, a domino effect, Devin, that really it hurts banks. If banks get hurt, they're not going to want to lend as much. I mean, I just think back to the financial crisis, which was really focused on real estate and the securitization of these. They blocked up the loans, cut them up into different tranches, and they're A, B, and C, and then some people just defaulted and just kind of collapsed the whole thing. We don't want that to happen again, which I think is why the expectation that we had the SBA program, the PPP, the Paycheck Protection Program, and other places. So we want to avoid that at all costs.
Yeah, absolutely. And look, I get it. To the everyday viewer, you might think, who cares about the banks if they're going to have financial issues? But to your point, everything is interconnected. And I think what people are starting to realize is that the seizing up of money, when money stops flowing, it means that someone isn't receiving it on the other end. And a lot of times that kind of system, the whole thing flows and is interconnected back to everyday people. Yes, they may be shareholders of banks, but also they may be potential borrowers who are not going to get credit because the bank stopped lending, as you said, because they're having existing issues with their own loan book, because those borrowers aren't getting aid from the government, because their businesses are shut down, which was imposed by the government. So again, everything is interconnected. And so I think just the flow of money, you can tell the government is really focused on that. Whether they're executing it 100% perfectly is up for debate. There have been a lot of issues and timing issues and getting that money flowing, but you can tell that timeliness has really been of the essence in this crisis, compared with the last financial crisis when aid actually took a couple of months. I'm trying to remember. TARP was approved into November. So, aid discussions were just happening for months and months. So you can tell that timeliness is of the essence this time. And
also, just to point out, if you are in a 401k or 403b or 457b, you may own a mutual fund that invests in Citigroup or Bank of America or JP Morgan. So it is all interconnected. Let's hope that in our first segment, Devin, as we end our episode, that these fintech companies offer solutions that we can get the money flowing. And in the second segment, let's just hope that we get money and that people get money and they do not default on those loans. That's the last thing we want, because it has all this impact. Devin, always a pleasure talking with you. Very insightful. People should certainly check out This Week in Finance newsletter. I read it every Friday. It's one of my favorites. And Devin, always a pleasure talking with you. Stay safe, and we'll talk to you soon.
Thanks, Jeff. Take care.
And that wraps up this episode of BRN AM. Have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, and so much more, check out today's edition of The Morning Pulse. And don't forget, we're back again tomorrow for our weekly show, BRN Weekly, and I'll be joined by special guest, Keith Brainard. He is the research director for the National Association of State Retirement Administrators. We're going to talk a lot about pensions. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.